Hey there, welcome to the Explainer. Let me ask you a question right out of the gate. Are you ready to make the leap from residential to commercial real estate accounting? Because if you are, you've got to know that you're stepping into a totally different landscape. You're basically leaving behind the simple, predictable world of fixed monthly checks and entering this complex territory driven by highly customized, multi-layered lease terms. It's a whole different ballgame. And if you don't have the right foundational knowledge, well, these commercial complexities can quietly eat away at your profits and put you completely out of compliance. But hey, don't sweat it, because that is exactly what we're going to unpack today.
Okay, let's dive into this. Here's our roadmap for today. We're going to follow the chronological life cycle of a commercial lease to demystify all of this. We'll start with the commercial accounting leap, move into tenant improvement allowances, then mastering CAM and service charges, hit on ASC 842 and IFRS 16, and wrap up with purpose-built property accounting.
Section 1. The Commercial Accounting Leap. And the very first thing you have to realize here is that managing a commercial building requires moving far, far beyond basic rent collection apps.
Think about it. A standard residential lease is usually just base rent, right? It's predictable. But a commercial lease, it is a living, breathing financial contract. You've got your base rent, for sure, but you also have common area maintenance reimbursements, tenant improvement allowances, and scheduled rent step-ups built right in over multi-year terms. The financial realities are multi-layered. That means your accounting approach literally has to be accrual-based and incredibly structured just to capture everything accurately.
Section 2. Tenant improvement allowances. This brings us to phase 1 of the commercial life cycle, customizing the build-out space for a brand new tenant.
So what exactly is a TI allowance? By definition, tenant improvement allowances are funds provided by a landlord to a tenant to help pay for the customization of a commercial space. We're talking about things like putting up new walls, installing specific lighting, maybe building out a retail storefront. As the landlord, you're fronting this cash to secure the lease. But from an accounting perspective, you have to track these funds incredibly carefully. They aren't just everyday expenses. They are capital improvements or lease acquisition costs.
Here is where it gets tricky, and it's all dictated by the gap matching principle. Let's say a pipe bursts and you pay a plumber. Boom, that's a routine repair, an immediate deductible expense in your current year. Simple. But let's say you agree to an $18,500 build-out allowance to secure a new commercial tenant on a 5-year lease. You absolutely cannot just expense that $18,500 today. Because that build-out generates revenue over a 5-year period, the matching principle says you must capitalize that cost and amortize it evenly over the life of that 5-year lease. Mixing these two up? Yeah, that's a massive audit trigger, so precision here is absolutely key.
Section 3. Mastering CAN and service charges. Now the tenant moves in, and we transition to the day-to-day ongoing operations.
In commercial real estate, operations means mastering common area maintenance, or CAM, and service charges. Unlike residential, where the landlord just eats the cost of landscaping or hallway lighting, commercial leases pass these shared costs like property taxes, insurance, and maintenance straight back to the tenants. But it's got to be fair, right? So a tenant's share is calculated strictly by their pro-rata square footage. If they rent 20% of the building's total square footage, they are responsible for exactly 20% of the shared CAM costs.
Let's put some real numbers to this. Say at the end of the year, the total actual CAM expenses incurred by the entire building, we're talking snow removal, landscaping, lobby utilities, the whole shebang, come out to exactly $50,000.
So what does this mean for our 20% tenant? Well, because they occupy 20% of the building, their specific allocation of that $50,000 total equals exactly a $10,000 share for the year.
But wait, here's the catch. You don't usually wait until December to drop that bill on them. You've been charging them estimated monthly CAM fees all year long based on an initial budget. Let's say you only billed the tenant $9,000 in estimates throughout the year. Well, since their actual share of the real costs was $10,000, you've got a gap. You have to accurately reconcile the books and send them a year-end invoice for that remaining $1,000 difference. And honestly, if you'd overestimated, you'd owe them a credit.
This means the whole intimidating CAM lifecycle really boils down to 3 very clear phases. First, you estimate and budget at the start of the year. Second, you meticulously track your actual expenses to the general ledger all year long. And third, you perform that critical year-end reconciliation. Trust me, if your general ledger isn't flawlessly categorized, pulling those actuals for step 3 is going to be an absolute nightmare.
Section 4. ASC 42 and IFRS 16. Let's zoom out a bit to the macroeconomic view and look at the heavy year-end reporting requirements mandated for audited financials.
If you are dealing with institutional investors, lenders, or audited financials, you have got to comply with ASC 842 under US GAAP or IFRS 16 internationally. I know, these are heavy compliance terms, but basically they are accounting standards that require lease assets and liabilities to be recognized directly on the balance sheet, and they mandate straight-line rent calculations. Lenders and investors care deeply about this, for sure, because it stops companies from hiding massive lease liabilities completely off their books.
Let's get into the weeds of these mandates. The biggest headache for property managers is definitely the straight-line rent calculation. Think back to Phase 1. Say your lease includes a rent-free period, like you gave them 3 months free to move in. Or maybe you negotiated step-ups, where the rent increases by 3% every year. Under ASC 84, too, you can't just report the cash you actually collect each month. No way. You literally have to take the total value of all lease payments over the entire term, average them out, and recognize that flat, straight-line average as revenue every single month, regardless of your actual cash flow. Add in right of use, or ROU, asset recognition, and managing deferred revenue for prepaid rent. It is mathematically intense.
Section 5, Purpose-Built Property Accounting. Which brings us to our final structural journey, the system solutions you actually need to handle these complex financial hurdles without losing your mind. Because doing this manually, it's a recipe for disaster. Our sources hit the nail on the head here. They state, if CAM reconciliation happens outside the accounting system, it is a separate process that is impossible to audit cleanly. This really highlights the immense financial risk of using disconnected spreadsheets for commercial property management. Seriously, if you're calculating that $1,000 CAM gap on a desktop Excel file and it doesn't dynamically link to the invoices in your general ledger, your auditors are going to have a field day with you. So, what do you actually need? Your finance team has to look for non-negotiable features in purpose-built platforms. Think Released, AppFolio, or Yardi. You need native multi-entity support to juggle all those different property LLCs. You need automated rent billing that reads those step-ups straight from the lease data. You absolutely need general ledger-connected CAM reconciliation so every single dollar is tracked to the penny. And you need automated ASC 84 adjustments to handle those complex straight-line calculations for you. That is how you ensure true GAAP compliance and accurate multi-entity consolidation.
Ultimately, commercial real estate is an incredibly lucrative space, but the financial mechanics, they are completely unforgiving. A missed TI amortization, a botched CAM reconciliation, or a failed ASC 842 audit doesn't just cause headaches. It literally costs you real money and destroys investor trust. So I want to leave you with this provocative question to chew on. Are your commercial spreadsheets currently costing you profits and compliance? Because if the answer is yes, or even maybe, it might just be time to upgrade your operational systems. Thanks so much for joining me on this explainer, and I'll get you on the next one.